Hi, now welcome to the final episode of this module. Now in the last two episodes, we spoke about interest rate and GDP and how they impact our economy and their relationship with the stock market. In today's episode, we will talk about the devil in the story, which is inflation. So without wasting too much time, I'm going to start about inflation ASAP. So what is inflation? You might be wondering what inflation is. So formally, inflation is defined as the decline in the purchasing power of currency over time. But to oversimplify it, when too much money chases very few goods, it leads to inflation. Or putting it differently, inflation leads to increase in the price of goods and services over a long period of time, which devalues the purchasing power of money or currency. For example, if you could buy a cold coffee at Starbucks for 100 rupees today, but 20 years down the line, do you think with the same amount of 100 rupees could you buy the same cold coffee in Starbucks? Not possible. Now, you would have to pay way more than that in 20 years later, right, for the same item. But why is that? That's because inflation is at work here. Now, mathematically, it is calculated by recording the rise in the average price level of a basket of selected goods. Now, there are two basic types of inflation, very important, listen to this. First one is called demand pull. When the demand for goods and services exceeds the production supply, then the prices increase due to high demand as against the inadequate supply or less supply. Second one is called cost push. Now, when the overall increase in production cost leads to rise in prices of goods and services, then such a phenomenon is called cost push inflation. Now, inflation in India is affected by a variety of factors. Now, demand-supply mismatch for agricultural produce due to factors like uncertain monsoons or lack of proper storage, that is one problem. Now, rise in import prices for critical resources like petroleum, hoarding of goods and commodities also leads to inflation, and changes in money supply to the economy also leads to inflation. Now, just like GDP, inflation rate is also a lagging indicator, which means that any changes in the inflation rate represents the change in level that have already occurred. So you must be thinking that inflation is bad, right? And it would be preferable to have purchasing power of your currency rise. But actually, here's the catch. The inverse case, deflation, is much more harmful to modern economies. Now let's consider a case where we have deflation and the value of our money is rising with time. So you will obviously prefer to save the money rather than spending it and investing it. And this will be very detrimental for the economy. Why? Because consumption and investment are very important pillars that drive the GDP and economy of a country. And if deflation dents these pillars, deflation is much more harmful than inflation as it encourages people to hoard money, which is not good for overall business environment. Nobody will spend. Now, inflation in India is measured with two indicators. One is called CPI or Consumer Price Index. Now, this measures changes in the prices at a retail consumer level. The policymakers are much more concerned about the CPI because it affects individual citizens like me and you, right? The second one is WPI, Wholesale Price Index. Now, this measures changes in the prices for producers of goods and services. Now, some amount of inflation is good and always represents in growing economies, right? But the only cause for concern is whether the inflation is outside of expectations of the policymakers and the central bank of the economy or not. Now, each economy has a prescribed range for inflation, which is decided by the country's central banks. And this range is different for different types of economies. Now, generally, developing countries with high GDP growth rates will have high range of inflation as compared to developed countries with stable GDP growth rates who have smaller range for inflation. Now, in India, RBI officially looks to maintain a range of 2 to 6% for CPI. Now, let's look at the impact in the stock market. Now, that was about inflation. Now, let's see how the stock market gets affected directly by inflation. Now, as mentioned earlier with GDP and inflation, that both of them are lagging indicators, and the current GDP and inflation will not have much impact other than a short-term rise or a short-term fall, depending on how the figures come out versus the expected numbers. Now, the exact impact of the stock market from inflation is always changing, but we can see two conflicting effects of inflation on stock market. One is in inflationary periods, which are accompanied with high economic growth rate, generally have a positive impact on many stocks, especially cyclical stocks like commodity companies. This is because inflation significantly drives up the prices of their goods more than the price of inputs, and hence improves the cash flow of these companies. Now, let's see a case where inflation has a negative impact or negative effect on the stock market. Now, sometimes inflation may lead to an increase in the price of input raw materials much more than the price of products or services that a company basically delivers. Now, consequently, this will have a net negative impact on the cash flows of a company, and thus the market may react negatively to this. Now, another major negative effect is that inflationary periods are accompanied by increase in interest rates. Now, this is done by the RBI to prevent inflation from rising exponentially. And this rise in interest rates on debt instruments means that investors would want more return from their equity investments. Now let me explain all of this with an example. Now suppose you're getting 6% return on FD or fixed deposit. Now you'll be happy with a 10% return on stocks, considering investing in stocks is slightly more riskier than fixed deposit. But what if your fixed deposit starts giving you 10% return? Why would you put your money to play in the stock market with all that volatility when you can easily get 10% return with fixed deposits? Hence, people would want to take out money from the stock market and put it into the debt, which can actually dramatically impact and lead to a fall in the stock prices because liquidity goes up. Hence, we can see that inflation can have both positive and negative impact on the stock market, and we should try to understand which impact is more significant than the other. Now that's it for today's episode, and I'm also glad to say that this was the last episode of this module. Now I hope you guys have enjoyed this module on the relationship between economy and the stock markets, and hope you got a fair understanding of GDP, interest rates and inflation, and also how they impact our stock market. Now, as we conclude this model, let me tell you that it is almost impossible to make short-term market forecast based on GDP, inflation and interest rate. The stock market is run on future expectations, and hence the major impact on stock prices comes from changes in expectations of future GDP, inflation and interest rate change. Now, because the stock market depends on so many indicators, it is very hard to pinpoint what event precisely led to what market movement. However, one can take a long-term view based on these parameters. For example, over the next 20 years, if India manages to grow its GDP sustainably, keep interest rates in a downward trajectory, and manage inflation on a broad range, we can expect the Indian stock market to do extremely well. Now, of course, there will be booms and busts in the middle, but over a long period of time, we can reasonably expect an upward trend. So with all these discussions, finally, we have to end today's episode and this module as well. So I hope you guys like this. Till then, keep learning. I'll see you guys soon. Bye.